A very good morning to all of you students. My name is Devas Gupta and today we will be having revisionary aspects on the topic of securitization and then later on derivatives. So let's quickly discuss some of the concepts that we have discussed in the detailed session, right, in a revisionary aspect. So let's start with securitization, students. Securitization, students, we started with a normal case where we said that let's assume there is Mr. A who has taken a bank loan from a bank for 25 years, and this is a category of a home loan. And in return, Mr. A has decided or has agreed to repay the interest and principal amount to the bank, right? Because that's the primary condition. So the interest and principal has to be paid to the bank. Now, if you think from bank's perspective, the loan that bank has given to Mr. A will appear in the asset side, correct? Because for bank, it is an asset, it is a receivable. And similarly, the other line items for bank, maybe in equity and liability side, would be their equities, whatever we have deposited in terms of fixed deposits or recurring deposits will appear in the bank's liability part, right? Because the bank have accepted the money which will be repaid later on. And there will be other borrowings, there will be other loans that the bank have given, right? Because the bank's balance sheet is all about borrowing taken and loans given. Now, on all of these borrowings taken and loans given, bank would be paying interest on the borrowings and receiving interest on the loans that the bank have given, right? So on the asset side, whatever loans are appearing on that, bank will earn interest. On the liability side, whatever loans are appearing, whatever borrowings are appearing, the bank will pay interest. Let's assume hypothetically the bank at an overall level on a portfolio is paying an interest of 8%. And here the bank is earning at an overall level on all the portfolios put together as 9%. So that means 1% is bank's net interest income. This we call as net interest income. Okay. Now, assume that the loans that the bank have given, for that the funding is limited. Okay. If you see here, let's say the bank has given a loan of 100 crores. Okay. And here also from the sources side, also bank have raised 100 crores, let's say in the form of an equity or in the form of a loan. If you see here, the bank's earning potential is limited maximum to 1% of 100 crore, right? Because 1% is what? The net interest income into 1%, which is 1 crore. So this is the maximum earning potential for a bank. I hope all of you agree with me till now. Now, to increase this potential, because the bank is in the regular process of giving the loans, right? So that's the real business of a bank. So for that, there is a process by which the banks can further give loans, right, on the same capital using the technique of securitization that we will be discussing in detail in today's session. So the genesis of securitization. So one of the genesis of securitization is the is the situation that we have just now discussed. Now, if I talk to you that what is securitization, how it impacts the overall numbers. So, first of all, students, this home loan that we have given is an illiquid asset. This is a home loan that we are talking about. The answer is yes. This is a illiquid assets. What do you mean by illiquid assets? Anyone, students? Would anyone want to express their thought on what do we mean by an illiquid asset? When I say this asset is very liquid, then what is meant? Or when I say that this asset is very illiquid, then what do we mean by that? You can drop in your mm, comments in the chat as well. Perfect. So Miss Korukonda is saying readily cannot be converted into cash. Yes, the illiquid means that it is not readily available to be converted into cash at the full value, right? So illiquid, why it is illiquid now? Because the bank have committed, its funds into home loan for 25 years. So till 25 years, bank will be getting the EMIs, right, from the Mr. A, but it is not readily convertible into cash, right? So that is why it is called as an illiquid asset. So the home loan in question is an illiquid asset. That illiquid asset now bank will sell. So students, please do remember the bank is going to sell the illiquid asset. This is, I think, for the very first time, some of you might be hearing that how can I sell a illiquid asset? I can sell, let's say, my inventories. I can sell my fixed assets, which is, let's say, property, plant, and equipment. How can I sell my receivable? Yes, that is very much possible. Through the process of securitization, we are trying to sell the illiquid assets. Okay, that means sell home loan. If I just say sell a home loan, after selling the home loan, you will realize funds. We will come to that. How are we going to sell it? We will come to that. That's a very structural discussion that we will have, that how can we sell a home loan. But as of now, if I keep it aside, the next part is after selling the home loan, I will realize the funds. After realizing the funds, what we will do? We will lend off such funds to further people like Mr. A, and hence the bank's earning potential will increase because the bank now is churning the money, the same capital, into multiple rounds of loans that the bank is giving. I hope it is clear till now. Any questions till now? Any queries till now, students? We can make this very interactive by all of you putting your comments in the chat box, or maybe if you want to speak, that also is okay. Yeah, perfect. So with this background now, let's see how can a securitization process take place, right? By the way, this entire piece is called as, and another two more steps is called as securitization. Okay, now again coming back to the same example, that Mr. A has taken a loan from bank for repayment of principal and interest. Now what does loan represent, students? The loan represents the right to receive interest and principal repayments. This is from the bank's point of view. Bank's point of view, if you see, the bank is having a right to receive the interest and principal repayments. And since this is a housing loan is generally backed up by the property itself for which the loan is given. And hence these are called as mortgage loans as well, because there is a property that is being mortgaged, right? So we are just getting you introduced to some of the terms. Whenever we call it as a mortgage loan, it means what? Mortgage loan means a housing loan wherein there is a mortgage created. What is the mortgage? The mortgage is the security. That house itself is mortgaged to the bank for the purpose of giving a loan. Okay. Now, if you see, This is Mr. A. This is bank who has given the loan to Mr. A on the understanding of repayment of principal and interest at the rate of 10%. And now what will bank do? Bank will contact an SPV. Bank will get in connection with an SPV. This SPV is called as the special purpose vehicle. The idea behind this SPV is that it will purchase the loan, pay the amount, and also issue securities to the different types of investors. Okay. So if you see, the bank will transfer the right to receive the principal and interest. That's what the bank will do because I'm selling the loan. If you see from bank's point of view, the bank is selling the loan. Selling the loan means transferring the right to receive the principal and interest, right? That's what the substance over form is. And the bank will receive 100 crores from the SPV itself. Clear? Then, from where SPV will arrange funds? That can be the next question. The SPV will arrange funds by issuing securities. Okay. So, what do you mean by securities? Securities are the instruments through which the funds are raised, right? So, it will take it from whom? The pension funds, which have a capability to invest. The mutual funds, they are also looking for investments. Banks, institutional investors, and high net worth individuals. So all of them are actually looking in for investment into a proper venture. And these parties will subscribe to the securities that SPV have issued, and in a way SPV will be having funds which will be paid to the bank, and in return SPV will get the home loans that the bank have given, and in a way the rights to receive principal and interest have got transferred from bank to SPV students. Clear? So if you see, in our example, we have taken a 1 crore loan. Like Mr. A, there will be thousands of other borrowers as well, right? Because the bank would have given loan to many. So let's say this becomes 1,000 crores. The loan value becomes 1,000 crore, and the overall weighted average tenure becomes, let's say, 20 years, right? So the total corpus here is how much? 1,000 crores. Now the bank will receive 1,000 crore today and transfer the right to receive the principal and interest to SPV. What will SPV do? SPV will issue securities, let's say, of this 1,000 crore into different units. Might be one unit can be for 100 crore. There will be 1,000 units, and hence 1,000 crore will be the amounts. Clear, students? So this is the basic principle of a securitization, wherein we are converting an illiquid asset, which is a home loan, into marketable securities. These are called securitization. So illiquid asset, which is actually the pool of funds, the mortgage loan, getting converted sorry, into the marketable securities. Now, students, it hardly matters that this illiquid asset was given by a bank, right? The bank had given this illiquid asset, and the marketable securities is what? Marketable securities is issued by SPV, special purpose vehicle. So, this process is called as the securitization process. Okay, because ultimately what you are doing is you are converting your long term committed investments into smaller marketable investments which can be sold tomorrow. So maybe these investors can also start trading in these securities so as to increase the liquidity of these investments. Now, there are two terms, students, which we need to understand. One is mortgage backed securities, which is also called as mortgage loan. Why do we call it as mortgage backed? Because the securities that have been issued here are for the home loans, and home loans, the underlying of that security is what? Home loan. And the home loans backup is the mortgage loan, right? Because it's called as a mortgage loan. Then there is a term called asset backed securities. Now, other than home loans, the the receivable for the bank arises due to many other things, right? So it can be due to credit card receivables, automobile loans, or other things. So that is called as asset backed securities. Okay, now let's understand this chart a bit into detail. Okay, with some of the technical terms. Now there is a borrower, right? Let's say Mr. A, the same thing. So there are, let's say, 1,000 borrowers at the rate of 1 crore each. So that means there is 1,000 crore of corpus. There is a 20% probability of default. There is a 20% probability of default, students, for these set of borrowers. And the default will be 50% of the amount. Okay. So do you understand? I mean, with the overall assessment of the portfolio of these borrowers, it is arrived at that 20% there is a probability of default, and 50% of them will not be able to pay the amount. So this is the actual default. So 1,000 crore into 20% into 50% is 100 crore. So out of 1,000 crore, 100 crore roughly will get defaulted. Correct? That's what the understanding is. Now this originator is called as bank because bank have originated these loans. They are the real they are the real originator of the transactions due to which the entire securitization is taking place. Then there is SPV that we have already discussed, right? The SPV, special purpose vehicle, which is enacted specifically for the purposes of taking the loan, right? Of buying the loan and issuing the securities. Now there are two terms, students, that we need to understand. One, recourse. Second, non-recourse. Now, what do we mean by recourse and non-recourse? Would anyone would want to say what is meant by recourse and non-recourse? So the student, this is a general term, not anything specific to securitization. What do we mean by recourse and non-recourse? So the recourse one is what, and the non-recourse one is what? So Ms. Korukonda is saying risk of non-payment is also transferred in case of recourse. Okay. If I read it right, risk of non-payment is also transferred in case of recourse. Correct. It's a default risk. Okay, now let me explain. So there can be two different scenarios here. One, there is a recourse. Second, there is non-recourse. Now, in case of recourse, the the SPV to whom the loan has been transferred will have a recourse in case the payment is not received, right? So that means the risk is not transferred, the risk of non-payment. So eventually this 100 crore that we have talked about is the default amount, right? So this 100 crore might not be recoverable from the borrowers, and this is the risk that we are carrying. So in case of a recourse transaction, the SPV will have a recourse to originator in case this 100 crore is not received. So that means the risk is not transferred, risk is not transferred. And in case of non-recourse, whether the amount will be received by SPV or not, the bank has no role to play. So the risk is transferred. The risk of non-payment is transferred to SPV. Clear? So this is what, in case of recourse, allows SPV to get funds from originator in case borrower defaults. Correct? Because then there is a recourse available. In non-recourse, no entitlement to the funds from originator in case the borrower defaults. So the SPV has to bear the loss. Clear? So I think Ms. Kurukonda, if you see, risk of non-payment is also transferred in case of recourse. So I think it's a vice versa situation. In case of non-recourse, it is transferred. Right? In case of a non-recourse, the risk is transferred. Okay? Perfect. Now, yes, this is how we explained. So if 100 crore is the actual default, in case there is a recourse, this default will be borne by bank or originator. In case there is a non-recourse basis arrangement, then it will be borne by SPV itself. Then students, we have introduced some more other parties to the process of securitization. Let's see. So there is a borrower, there is an originator, there is an SPV. Okay. So there is a borrower, there is an originator, there is an SPV. Okay. Now, if I introduce other parties to it, then there is a party called receiving and paying agents. So the receiving and paying agents are the ones who are responsible for doing the collections from borrowers and then accounting for it and then remitting it to the SPVs. Because you will need some person, some agency in between which can handle the process of receiving and the payment, right? So they are responsible for managing the collections, right? For example, let's say sending the reminders, collecting the amounts, making sure it is knocked off against the correct receivable, right? In case of any change in the borrowers, also accounting for it, and then sending it the remittances to SPV. Okay, because SPV will also want the amounts that are coming should be properly accounted and segregated. So this is the role of receiving and paying agent. Then the second agency here will be the credit rating agencies. Now I will tell you what is their role. So investors are something that we have already discussed, right? These are the investors which are willing to invest in these securities. Now, if you see the entire process, ultimately the investors' money is reaching to borrowers, right? Through the entire channels, investors' money is reaching to borrowers in a nutshell. Because investors give money to SPV, SPV will pay to originator for purchasing the loan, and originator will give the money to borrowers. Essentially, not in the same sequence. The sequence is reverse. First, borrower will receive the money, then originator will sell the loan, then simultaneously SPV will issue the securities, right? So this is the order. Now, if so, investors really don't have visibility in which what is the underlying where they are going to invest, and hence there is a risk. To avoid that credit risk, the role of credit rating agency emerges, wherein the credit rating agencies will be responsible for getting into that what is the credit quality of the underlying, what do they rate or how much do they rate in terms of the credit rating, and accordingly the investors, if it is a highly risky proposition, right, so accordingly the investors can decide whether they would want to continue with their investment or they want to exit with the investment or what, right? So in a way it does help in terms of backing up the investors' sentiments. Okay. And similarly, SPV can use the credit ratings as well, right, for marketing their securities. If the credit ratings are good, they can demand more, let's say, discount to the securities. Or if the credit rating is not good, they will have to pay premium to the investors while issuing the securities. I mean, they will end up paying the higher amount of return to investors. Okay. Then, so the role of this is also clear, students, the credit rating agencies. Then the third ones are trustees. Now these SPVs are mostly in the form of a trust. Now if these are the trusts, then there has to be some trustees as well who are entrusted with the responsibility of overseeing this trust. Okay, clear everyone? Perfect. So yes, I think there is some queries. Pushpadanta, yes. Recourse is when the default is reimbursed. Yes, that's what we clearly discussed. When the advances are out of the bank balance sheet, is any other option is there? Is it come out of the balance sheet whether credit rating is on the borrower or SPV? Okay. So there is a question from B. Kiran Kumar. So both the situations are possible. So the question here is whether the after the advances have been sold to this SPV, right? So in our example, this one, the bank have sold the loans to SPV. So whether the loan sold will come out of the balance sheet or not. So both the ways are possible. It depends on their arrangement, whether they have agreed to a synthetic kind of a transaction in which the loan will still appear in their balance sheet, but all the risk and reward is transferred. And there can be other situation as well in which the loan in entirely it comes out of the balance sheet of the bank. Okay. So Pushpadanta is asking whether the credit rating is on the borrower or SPV. So actually, if you see, the credit rating is on the underlying assets for which the securities are issued. So it is on the borrower. Okay. It is on the borrower and even the assets that these borrowers are holding. For example, the homes, right? The mortgages that these people are holding. Okay. I hope this is clear. Perfect. Now, moving ahead. Now there are different types of securitization instruments, students, right? One is called as pass-through certificates, which is called as PTC. Second is called as pay-through securities, which is called as PTS, and the next one is stripped securities, which is called as SS. Now, if you see, we are talking about the leg where the SPVs have issued securities to the investors, right? We are talking about that leg here. So it can qualify three different forms. All of them have their own relevance and all of them have their own characteristics. Let's see once. So I think this is a good discussion where we discussed that if this is the security, then what is the underlying? So let's say if debt is the security, the underlying is definitely the interest rate. If equity is the security in the form of equity shares, so whether the return is in the form of earnings or dividend, the business is the real underlying, right? The underlying is the business, and there is no fixed commitment here. If we talk about the mutual funds, their NAV, equity, or debt becomes the underlying, right? The NAV which is derived through the form of equity or debt. Then, what about derivatives? We will be discussing in our upcoming part of the session, right? The derivatives, there can be different forms of underlying. The mortgage backed securities or asset backed security students, it's actually the mortgage loan and the other receivables that are being taken up, right? So these are called as the underlying for these mortgage backed securities and asset backed securities, because while securities are issued to investors, these mortgage loans and receivables act as an underlying. And then securitization related securities, which is nothing but MBS and ABS and others. So where that is the pool of funds or the illiquid assets for which the securitization has happened. Correct? So these are the underlying. Now, if we talk about pass-through certificate students, so we need to understand the different cases through which we will tell you what is the pass-through certificate. So the first case is where there is a borrower, there is a SPV and there is an investor. Okay. So the borrower is supposed to pay 100 of principal and 50 of interest. And apart from that, 150 prepayment is also being paid. So in totality, 300 rupees is paid. So if you see students, the regular EMI amount was 150 here, but there is a extra prepayment of 150 more. So in totality, the SPV gets 300. Now SPV, since this is a pass-through certificate, it will directly go on and distribute the 300 to investors. Clear? It will directly go on and distribute the 300 to investors. So this is called as pass through. So SPV, whatever is receiving, it is just acting as pass through. Second example, if let's say the borrower has paid only 150 rupees, which was originally designated to be paid, still 150 will be paid to the investor as pass through. The answer is yes. Case 3. In case, let's say now the borrower actually defaults. Instead of 150, the borrower only pays 80 rupees. It can be the case, right, where the borrower is paying less. So now there is a default and it only receives 80. Now 80 only will be distributed to investors proportionately, not 150, because the balance amount it's not going to come from anywhere, right? So 80 rupees itself will be paid to the investors. Okay, so 80 rupees will be paid in terms of proportion to the investors. Now, for investors, the pass through certificates is basically the proportionate share in cash flows of SPV. You're getting? So it is just about whatever SPV is receiving in terms of the cash flow, the proportionate share becomes the, because of the pass through certificate, the proportionate share becomes available for the investors. Clear, student? Yeah. Now, if we talk about the cash flows of investors, they are directly actually linked to the cash flows of the mortgage loan held by SPV, right? Because they're just acting as a pass through here. Now, second example, second case is of the pay through security students. So, the pay through securities is basically the second case. Now, we will discuss in detail. Um, Before that, in case of a pay through securities, there will be an agreement or there will be an agreed position between the SPV and investor that, let's say, 200 is the guaranteed cash flow that will be paid. Okay, for example, there is a borrower, there is a SPV, and there is an investor, right? Again, there are these three parties. The borrowers are paying in totality 300 rupees to the SPV, right? 150 in the form of regular EMI and 150 as prepayment. So 300 is received students, but there is an agreement that minimum, or let's say that as a commitment, 200 will be paid to the investors. Now, 200 is what will be released to the investors, not the entire 300. balance 100 rupees will be invested by the SPV. Clear? So this 100 rupees is invested by the SPV itself. Now in the second case, students, there is a borrower, there is a SPV, there is an investor. Now the borrower again pays 150 in totality to the SPV, 150 minus 200. Now here 50 there is a shortfall. No, Jyoti, SPV can invest anywhere else as well. Okay, it's not necessary that SPV will invest only with the originator. In the case one, this 100 rupees, it can invest in any form. Now, this 50 rupees shortfall, earlier investment to be utilized. Now, this 50 rupees, the earlier 100 rupees will be utilized now, and in totality, 200 rupees will be paid to the investor. Case third, now nothing is being paid. There is a default. Now, what will SPV will do? SPV will still have to pay 200 rupees, right? Had this been a case of pass-through certificate, nothing would have been paid to the investor. But this is a case of pay-through securities. 200 rupees is the committed payment to the investors. Then, for this 250, there was a earlier balance investment, and 150, the funds will be borrowed fresh and will be paid to the investor. So the 200 commitment have to be met. So pay through security has an element of ensuring that SPV has the rights to invest, has the rights to borrow, right? Basis the need that they have. Okay. Originally, the loan interest is enjoyed by the bank only. Now, so many came and income is shared by them. Then, what is the benefit of securitization? No, so B. Kiran Kumar, the question is that if the interest now is shared, then what is the benefit? The benefit is that now the bank can actually give more amount of loans with the same amount of capital that the bank is holding. Right? As I explained here, the real benefit. So there are first of all multifold benefits to answer you. Okay, the first benefit is that because of this limiting capability of 100 crore being invested again as loan, now what we have against this 100 crore we can give multiple times the loan, because we will give the loan, we will sell the amount, we will sell the loan to the SPV, and then again we will give the loan. Again, we will sell the loan to SPV. Again, we will give the loan. So the churning can happen. That is the first benefit. Second benefit, it is held convert your illiquid asset in the entire process to marketable securities. This one, right? Now you can deal. You can do the purchase sale of these securities in the market, right? And it has broken down into specific denominations as well. Okay, perfect. Now let me move ahead. So I hope the difference between pass-through certificate and pay-through security is clear. Now this pass-through is basically wherein, let's say, a layer is created, an additional layer is created, which is just acting as a pass-through. Okay. Then the pay-through security, students, the PTS, the cash flows of investor is not linked directly to the cash flows of the mortgage loan held by SPV. That is what we have discussed. They are both, the legs are separate. Whatever is the commitment to investors will happen. Similarly, the surplus and shortfall, the surplus can be invested and the shortfall can be borrowed. Then PTS, the pay through securities, are these are separately identified from that of the mortgage loan, right? PTC, same identity as that of the mortgage loan. There is a recourse, and so there is a recourse. If there is a recourse, then there is a risk, right? Now, PTS, we are actually desynchronizing two things, right? One is the cash flows paid to the investors and cash flows to be received from assets, right? So the PTC, which is the pass-through security, it's there is no stability in the cash flow. it can lead to spikes in the cash flows. PTS, it's a stable cash flows securities, right? Because you will still be getting 200, 200, 200 as a commitment, right? I hope the PTC and PTS is clear, students. We can move to the stripped securities then. Yeah. Then moving to stripped securities. Now, stripped securities, what do we mean by strip? Strip means creating different pieces, right? Creating different pieces. Now, if you see this 150 rupees, the same example, 150 rupees of the overall payment has two parts, 100 rupees of principal and 50 rupees of interest, right? So 1000 securities at the rate of 1 crore each being issued, right? So let's assume in our previous example that we have said, right, 1000 into 1 crore. So that means 1000 crore. Now these are called as principal only and interest only, because in this case what we are doing, the overall amount we are stripping into two parts, right? 100 of principal and 50 of interest. So there is a interest only security, there is a principal only security. The principal only security will be carrying the characteristics of the principal repayment payments. The interest only securities will be carrying the characteristics of interest only payments. So SPV is going to sell IO and PO separately in the market. So SPV is basically what? IO, different investors, and PO to the different investors. So, for example, if the interest only and principal only, let's say the value itself is 50 and 100 rupees, initially the interest rate of 10%. If now the market interest rate have increased to 12%, then your interest only security, the value will be higher, right? Because 50 earlier was 10% equivalent, now it will be 12%. But can anyone tell me what will be the impact on principal only security if the market interest rate goes high? If it is higher, then what is the impact on principal only security? Whether it will increase or decrease? Whether it will increase or decrease? If the interest rate increases, the principal only price should increase or decrease, students? As per the principles of bond valuation, right? What we do when the yield in market increases, the bond prices decreases because this is a principal amount. Yes, Lavanya, you are right, decrease. So it will decrease. So 10% was leading to 100. Now 12% will be leading to what? So 100 into 10% divided by 12%. So it will decrease. Yes, it's inversely proportionate, Jyoti. Yes. So the interest rate is inversely proportional to the bond prices. Or we can say bond prices are inversely proportional to interest rates. So hence this is the equation that we are following. Clear? Then if the market rate decreases to 8%, let's say at 10% it was 50 and 100. Now if the market rate decreases, then what is the scenario? Then for interest only security, the value will also decrease, but principal only security, the value will increase. Clear? Then I think this is the cost of equity formula. Cost of equity is the risk-free rate of return plus beta multiplied by market return minus risk-free rate of return. Right? And here we were also trying to establish that the market price is also inversely proportional to the cost of equity. Because if cost of equity is higher, the price will be lower. and vice versa. If cost of equity is lower, the price will be higher. Clear, students? Then there is a term called pass through certificate, right? That we have already discussed. So using that pass through certificate, now let's build upon this case. Now let's say there are three different types of mortgages: 100 crore, 200 crore, and 200 crore. In totality, 500 crore, right? The interest rates are different and the maturity is also different. 5, 5.5, and 6, and 2, 1, 1, right? So the SPV will receive 500 crores, right? Now, what is the weighted average mortgage rate? On 100 crore, it's 5%, 200 crore, 5.5%, another 200 crore, it's 6%. So it becomes 5.6. From that, the operational expenses will be reduced 0.6, and then we will be arriving at 5%, which is available for distribution, right? So that's how the pass through rate can be computed, right? So this is the pass through rate. Then, what is the maturity that we will talk about? So again, the weighted average of the three different loans. Yeah. So here SPV will propose to investors a return of 5% for 1.2 years, right? So that's the overall equation that will come out, students. Clear? Okay, so B. Kiran Kumar is asking difference between securitization and factoring. Yes, there is a lot of difference. So factoring essentially happens for short term and for single amount of a receivable as well. However, securitization is a very long process in which the securitization will happen for illiquid assets, a pool of funds for a longer time frame, right? A factoring is for a specific, for a smaller amount of receivable for a single transaction it can happen, and let's say for 2 months, 3 months, it is for getting the immediate availability of funds. But securitization, on the other hand, is for increasing the earning capability, and it involves more than two parties. It involves even the receiving and collecting agent, the credit rating agencies, the investors, the SPVs, right? So this is what the difference is. Yes, B. Kiran Kumar, you're right. These were the inversely proportional decrease and revenue and reverse. Yes, you are right. Perfect. So Lavanya is asking, in case of PTC recourse, pass through certificate recourse, if SPV gets the default amount from originator, should SPV pass on the amount received to investor proportionately? Yes, it will pass it on, because ultimately the amount belongs to investors. So it will also pass on the amount proportionately. Okay. Okay. Now these are the features of securitization. So it will definitely help in creation of new financial instruments. These are called as securities, right? MBS, mortgage backed securities, ABS, asset backed securities, which are used for doing the financial restructuring, right? Bundling and unbundling, students. Why do we say it? Pooling of funds is called as bundling, and unbundling is basically the securities issued to investors, that is called as unbundling. It is used for the purpose of tool, as a tool of risk management, because in a way, whether you do recourse or non-recourse, it will depend on the way how you want to manage your risk. Then there is a concept of structured finance, right? A structured finance means that you are entering into a financial transaction to finance your assets, to finance your loans in a structured manner. Then there is trenching we will discuss, and then there is homogeneity. Why we are saying homogeneity is because you have created a similar characteristic pool of funds, right? Then we already discussed about the participant students. There are primary participants, originator, SPV, investor. Then there are secondary participants also. For example, obliger, Rating agencies, receiving and paying agent, trustees, credit enhancer, and the structurer. The structurer's responsibility is to bring the everyone into a structure. Okay. These obligors are also called as the borrowers who have taken the loan originally. Okay. Clear, students? Then let's also discuss some of the issues or problems in securitization. So, as all of you know, students, that in India there is a concept and there is a law of stamp duty, right? So the stamp duty has to be paid while issuing the securities, while creating a debt, while creating securities, right? So it involves stamp duty. Second, the laws around taxation also plays a bigger role, right? So in the overall securitization process, what will be the taxability in the hands of the investors? Whether the amounts in the form of a dividend will be taxable at SPV level or at investor level, then the issues of taxability at SPV level, because it is acting, let's say, as a pass through, right? Then definitely problems in terms of the accounting. I think one of the question also got asked here, whether it is off balance sheet or whether it is a balance sheet related adjustment. So all of these things come up in terms of the complexity of the way that we have discussed and agreed, right? Then there is a lack of standardization, right? Now, what was happening is that lot of corporates or lot of companies were issuing securities on the backdrop of non-standardized products. Now, for example, home loans is something which is a standardized one. Now, for example, Air India tried to issue a securitize or to do a securitization process basis the future sale of tickets of their flight from a particular sector, right? So this will lead to some of the non-standardized products and some of the differences in the way the overall product is built in. Then there is inadequate debt market, right? So debt market is basically the availability of sources, availability of the funding, right? Then there are ineffective foreclosure laws as of now. So if, let's say, I have a loan that is being operated and if I have to foreclose it, right, then what are the different laws? So that is also one of the problems in securitization, because it will mean somewhere to prepay, somewhere to delay pay, right? So it will have an impact in overall situation. So that's whole about the problems in securitization, students. Clear? Then comes tranches, right? Trenching, we discussed already. Tranches means different levels. So there are different tranches. What are they? Senior, mezzanine, and junior. There is something called as senior, there is something called as mezzanine, means in between, and junior means small. Now, if I may want to say it, that there is a company which has equity shareholders, preference shareholders, and debenture holders, right? So can I say that these are three different tranches? The answer is yes. These are three different levels, because equity shareholders assume the highest risk and maybe the highest reward. It's a situation where they are having a highest risk. The preference shareholder students are having medium risk, but they end up getting a fixed sort of a dividend. Debenture holders, they are lowest in terms of the risk, and they keep on getting the fixed percentage of their returns. Clear? Now, if you see the similar thing is there in securitization. Now let me explain how. Let me explain how. There are investors. Perfect. So there are investors. Okay. Now we are talking about the situation between SPV and investors. Okay. We're talking about this relationship between SPV and investors. Now, SPV knows that the overall pool of funds that the SPV has taken have different risks and different rewards, right? It has different category of risk. Now, let's say the SPV decides that I will create three different levels in which the level one will bear the highest risk, and if tomorrow the reward is also higher, the higher reward will also go to the similar investor. Here I would say lower risk and fixed return, and the third one will be no risk and fixed return. You're getting my point. So the creation of different tranches in terms of the risk and reward profile of the pool of the assets, and even keeping in mind the investors preferences, is called as the overall process is called as trenching, right? This is called as trenching because we are creating different tranches here. Clear, students? Any questions till now? Then we will go to a very interesting topic. B. Kiran Kumar, is securitization to be done by SPV only, or mutual fund institutional investors can do securitization? As per the overall structure, the securitization can be done by SPV, right? Because they have a special purpose enacted for the specific cause. Okay? Mutual funds and institutional investors can be the investors in the entire process, but they cannot do securitization because they are enacted for a different purpose. Okay? Okay. Then, perfect. Okay, let's move to the next topic called blockchain and tokenization. Okay, this is a very important one. Okay, so first of all, would anyone want to share the thoughts on blockchain? What do we mean by a blockchain? Or what is your understanding of blockchain? Any ideas, any thoughts will be definitely appreciated. So okay, let me say then. So blockchain is a technology. It's a technology in which there are two things. One, there is a block, and then there is a chain of those blocks. Okay, just if I just decipher the word blockchain, there is a block, there is a chain. Now, if you see, the below table represents the in a diagram what is a block and what is a chain. So if you see, there is a block 1, there is a block 2, block 3, block 4, and similarly there is a chain of these blocks. Now, where is this used for? Or what is the characteristic of this blockchain? So, first of all, it's a chain of blocks. In a technology, it's a chain of blocks. It's accessible to users, right? Users have an access to it. And when I say users, these are millions of users, not only a single user. This operates on a technology called distributed ledger technology. Assume that you are so let's say you are a team of 5 or 6 people and all of you are working on a shared Excel file, maybe, wherein all of you can update at the same time. So it's a decentralized way of updating the things, right? For example, if I want to enter in column A certain things, I can enter simultaneously. If there is a another user, he or she wants to enter into column B, they can still enter into column B, right? So it's a distributed ledger technology. It's called as distributed ledger. So the ledger is distributed and all of them can make the entry at the same time. Now, where does it work? For example, there is an Indian company. It wants to send money to the Australian company, and they want to do it at 100. Let's say they want to send $100. Now, there is a block that will get created that Indian company is sending Australian company after paying Indian company's balance is $200, pay $100, right? And these information will be stored in a block, and this block will be added to a chain. Now, this will be visible to the Australian company, to the Indian company, and to the other companies as well, which are part of this blockchain, right? Now, this will be broadcasted via the network, right? Broadcasted means it will be shown via the network. Then there is a cryptography that will be used to validate the transaction, right? So there is a cryptography. I mean, there is a cryptography that we do, right? Wherein the messages will be encrypted, and using that, the validation will happen. It is represented as a block, then it is added to the existing blockchain, right? And then the transaction is deemed to be complete, and then the next blocks will be added. Now, there are some of the applications of blockchain. Financial services. Just now we saw if there is a foreign remittance needs to be done. If, let's say, the data needs to, let's say, the share purchase and sell needs to be taken up. So that those are all called as the financial services. Healthcare. Now, this blockchain technology, because in healthcare, what happens? You will have to preserve the sequence of events, right? Which are leading to the business, which are leading to the medical condition. Let's say some of the investigations, some of the doctor prescriptions, some of the medications. So all of them can be preserved in a sequence using the in the form of a blockchain technology. So that's where the intervention of healthcare is coming in the, oh sorry, that's the intervention of blockchain that is coming in the healthcare. Then government records. If you see any registrar office, there are so many documents. So all of them can be arranged via sequence of events using the blockchain. Travel industry students. Travel industry also, there are a lot of documents. One, let's say there are passport, visas, right? And lot of other documentation which can again, blockchain as a technology can be used to do all these things sequentially. Then economic forecasts, right? Because it involves a lot of data crunching, and the overall situation can be managed using the blockchain technology. Then there are risks associated with blockchain students. So first of all, you are a member of that network in that blockchain that is operating. That means there is some responsibility that is encasted onto you. Then there is a technology risk as well, right? It might happen that the technology might not be operating in that fashion in which, let's say, it's a completely risk-free transaction. Then there is no central authority. For example, banking, there is RBI; insurance, there is IDA, right? So So there are different central authorities which are governing the highly risky ventures, but in this case there is no central authority. And then it also involves a humongous data, wherein the data involved is not so limited, right? It involves higher amount of data. So this is all on blockchain, students. So from a technology point of view, it's a technology in which the multiple users are updating their information at single go, right? And it's distributed to many of the people to update their databases. However, there are some of the administrators to these technologies whose responsibility is to validate what all information is getting into, right? And then accordingly broadcast that token and add that token into the blockchain, students. Okay, not token, sorry, the block. Okay, now let's come to the tokenization. Let me see quickly in case of any queries till now. Yes, data stored in simple units transaction wise. Correct. So it's just about the data being stored, right? Perfect. Now let's come to tokenization, students. It's similar to the process of securitization that we have studied, right? With just one or two tweaks. So tokenization is the process of converting tangible and intangible assets into blockchain tokens, students. Now, if you see there is a painting, for example, okay, there is a painting. It's a intangible creation, right? It's an intangible creation of an art and a law, of an art and a craft. Now, because of that intangible creation, it might be that if we convert it into a digital token, it might reach out to large amount of users database, and they will be able to deal in those paintings in a better or in a liquid manner, right? So that's where we convert the intangible or even tangible assets into a blockchain token, right? So this is a token attached, there is a specific identity of that token that will be basically used to represent that picture. Okay, now, so this also converts your illiquid or let's say less liquid asset into a marketable securities which is more liquid. Right now, what are similarities, students? There is a liquidity, right? Because it helps in injecting the liquidity into the entire process. It also helps into diversification, right? Through liquidity or through creation of these tokens, you can also trade, right? It's not only limited that, once you have purchased and kept it, you can still purchase and sell it multiple times, and there are new opportunities to it. Clear? Any questions, students, in tokenization? Now, why it is relevant in securitization? Because in securitization also, we are doing a similar sort of a thing wherein we are converting the illiquid asset into marketable securities, right? So here also we are doing that only. We are trying to convert the intangible asset or even the tangible asset into a token, and that token will be used to do the trading or sale or purchase, students. Okay, so this brings us towards the end of the, just a second, sorry, this brings us towards the end of the revisionary topic of securitization, right? So there are certain different MCQs. So these MCQs I'm not covering again because these would have been covered in detail, right? In the detailed session. we have some different MCQs that we will be covering towards the end of the today's session, right? So as to see the overall understanding as well. Okay. So any questions in securitization, students, or we can move to derivatives. So if I just sum up the overall securitization process, the securitization process is done with the objective of converting the illiquid assets into a marketable securities. That is point number one. How it is done? Through a proper structured way, through a proper structured manner in which the the bank who has originated the loan will transfer the loan to an SPV, and that SPV will issue marketable securities to investors, right? So it's a very simple transaction of securitization. Okay. And there is a specific act that we just now saw, Sarfacy Act, right? That is used to, that's the law that is used to govern the securitization process. Clear? Okay. Then let's move to the, wait just a second. Let me share the derivatives. Let me share the screen. Yes. Perfect. Should we start derivatives now, students, then? Okay, so I think there are a couple of questions from B. Kiran Kumar. How securitization related to NPA? So securitization and NPA are two different things, right? Securitization, as we discussed the entire part, NPA is the non-performing assets by the bank. Now, sometimes what happens, the bank want to get rid of this non-performing assets, so they might want to treat these NPAs using the securitization. That's a separate thing. Okay, perfect. Let's come to derivative, students. Derivatives, again, a very, very important and interesting topic, I would say. A good amount of scope in this. So just be with me for all the conceptual understanding, the revisionary part. Ask as many questions as possible. It's a very, very interesting thing. And once you understand the basics, then you will be definitely having a good amount of interest to explore it further. Okay. So, students, derivatives, first of all, is a financial instrument. Okay. What do we mean by a financial instrument? A financial instrument is an instrument which is used to carry out some of the transactions. And why do we say it is an instrument? We can also call it as a contract, right? It's a financial contract. Now, A is a financial instrument which derive its value from B. It derives its values from B. What do we mean by value? What do we mean by derive? Derive is simply that it is dependent on the value of B. Value means the financial value, right? Let's say if I go in the share market and if I have to purchase a share, there is a market price quoted there, right? So it keeps on changing, it has a value. Now, if there is some other financial instrument which is deriving its value from that share price, so that other financial instrument which is deriving the value is called as derivative. Clear? Okay. So there is a financial instrument which is deriving its value from an underlying. Okay. So in this case, there is A, there is B. So A is basically the derivative. Okay. Now, what can be different types of underlying, students? So the different kinds of underlying can be a commodity, right? What is a commodity? A commodity is a homogeneous product, right? For example, the pulses, for example, food grains, for example, cotton, for example, sugar, right? These are all commodities which are available, let's say, in a homogeneous set of category. For example, even metals, silver, copper, gold, right? So these all can be the commodities. Now, all of them, yes, very good. Rice, crude oil, natural gas. Jyoti, you're right. So now all of these have prices coming from the open market forces, right? Now today, if I want to say what's what's the pricing of gold or silver, right? It's really happening in the open market. Now there are some other factors also as of now that is influencing, but there is a independent price moving up or down, right, for these commodities. Now there is a financial instrument which derives its value from that commodity, that is called as derivative, commodity derivatives. Okay, that is called as commodity derivatives. Similarly, the underlying can be an equity of X Limited. Now this is just an example. Now let's say there is a equity share trading in the market at 100 rupees, right? And there is a derivative which is a separate one which is deriving its value on that 100 rupees, that is called as again a derivative because it is deriving its value. Now let's say today, from let's say tomorrow, this 100 rupees becomes 110 for equity share. Okay, now the moment it becomes 110, the derivative also will move in a, let's say, similar direction, maybe 9 or maybe 8. It will also change the value of itself in response to the value that is changed by the underlying. Okay, then the third kind of underlying can even be a foreign currency, the foreign exchange. Why foreign currency? Foreign exchange, let's say US dollar to INR, right? It's again the prices depends on the relative changes in the market. Now even that can be acted as an underlying, and there can be a forex derivative that can be deriving its value from the changes in the prices. Then there can be a derivative on index as well. Now what do we mean by index? Index is the market representation of all the shares. For example, Bombay Stock Exchange, National Stock Exchange. The index of Bombay Stock Exchange is what? Sensex. Similarly, National Stock Exchange index is what? Nifty. So what do they represent? They represent the price movements of top 30 and top 50 companies. So they take top 30 and Nifty take top 50 companies by the market cap. So they take their baseline as 100. And if let's say today is 5,000, that means 100 has grown to 5,000 from the date that they have taken a baseline. You're getting my point? So even on this index, it's a non-financial, I mean, nobody trades index. Let's say, okay, I understand somebody can trade commodity. I understand somebody can trade equity. I also understand somebody can trade foreign currency. But index, no one trades, right? It's just a information. It's just a piece of information that comes. Even on that, there are some derivatives that are operating which derives its value from those indexes. Those are called as index dependent derivatives. There is no specific term to it, but yeah, these are also called as derivatives. So we call them as Sensex derivatives, Nifty futures, Sensex futures, like that, right? Then another classic example is weather. Now, let's say weather have different. KPIs, right? Let's say the temperature, humidity, rainfall, right? All of them are also treated as an underlying in some of the derivatives. And the derivatives value will depend on what is the outcome of that weather, whether it is a 16 degree Celsius or 20 degree Celsius, right? So it's all defined in the contract. That's where I say it's a financial instrument come financial contract, wherein all these terms and conditions will be defined. So clear, students, step one for all of you to understand what is a derivative. A derivative in a literal sense means a derivative is a financial instrument which derives its values from an underlying. An underlying can be commodity, equity, foreign exchange, index, or weather, or many other things. These are just examples. This is not an exhaustive list, students. These five are just examples. There are many other things as well. That's what B. Kiran Kumar I just explained. Index, yes, is not directly traded in stock market, but there is a price movements that this index captures. Using the price movement, the derivatives can derive its value, and hence the derivative can trade in the market. Clear? Any other questions, students? You can ask as many questions as possible in derivatives. I'm telling you, and this is going to be really, really interesting topic, students. Okay. Now it all depends on you what exactly you would want to, let's say, take it out. Perfect. Now let's come to step 2 now, right? Step 1 is clear. Step 2 of understanding is now what are the other basic features of derivative. Okay, there is a buyer, there is a seller. Just like any financial transaction, there is a buyer, there is a seller. For derivative also, there is a buyer, there is a seller. So we are talking about A here. A was the financial instrument, students, and B was the underlying, correct? So we are talking about A. So there has to be a buyer, there has to be a seller of that A. So that means it involves two parties. Clear? So A, which is a derivative, let's say it has X and Y as buyer and seller. And B, which is an underlying, can have a different buyer and have a different seller, which is, let's say, M and N, and these two people are totally different from the buyer and seller of derivatives. This is the point that I was trying to make, that derivative are traded independently in the market and underlyings are traded independently in the market. The only link between them is that derivative is deriving its value. Simple. The buyer and sellers are separate. Clear? Second, the value of the derivative is dependent upon the value of the underlying. This we discussed. Then third, it it has a fixed tenure. The A, which is the financial instrument, which is the derivative itself, it has a fixed tenure. Let's say it can be for 1 month, it can be for 2 months, it can be for n months slash year. Okay. Then the next characteristic is that there has to be a settlement of these derivatives, right? There has to be a settlement of these derivatives. Now, settlement will happen through what? Now, by settlement, we mean that once the period is over, right? Once the fixed tenure is over, it means that whichever party has gained will receive the money, whichever party have lost will pay the money, right? So it will involve actual cash outflow and actual cash inflow. In some cases, it will also involve delivery of the underlying, because in some of the contracts it will also be mentioned that the contracts will be delivered, that the sorry the underlying will be delivered. So there can be two types of settlement possible. One, there is a net settlement, and second, there can be a gross settlement, students. Okay. We will discuss both the aspects in detail in the specific topics. So the net payoffs from buyer to seller or net payoffs from seller to buyer, it can happen either ways. It's not necessary that always buyer will pay to the seller. Okay, because we are not talking about the underlying here. We are talking about who has gained and who has lost. Maybe the buyer can be the gainer, maybe the buyer can be a loser, right? Perfect. So there has to be an element of settlement. We will discuss how. Then, what we have discussed till now, there are certain things which are fixed. There are certain things which are not fixed, right? So the underlying has to be clearly defined in the agreement and hence it is fixed. The quantity of underlying, the quality of underlying, and the time periods, these are all clearly defined in the financial contract to make it as a financial instrument. Then uncertain or variable will be the price of derivatives, which has made it as uncertain. Okay, because the price is something that is not very fixed, not very clear. Okay, yes, holder and issuer we can call it. While holder and issuer is a specific term, Jyoti, we will discuss it in detail while discussing the options. Yes, net settlement and gross settlement, both of the settlements are possible. Perfect. Okay. So these are the basic characteristics. These are the basic features of a derivative. Till now, derivative is something which derive its value. It has the buyer and a seller separate from the buyer and seller of the underlying. Then there is a fixed tenure, right? Just think about a contract. Contract always have a fixed tenure, right? 1 year, 2 year, 3 year. It cannot be for forever. So that's where it has a fixed tenure. Then after the tenure gets over, there has to be a settlement of it, right? Then let's come to different types of derivatives, students. Yeah, sorry. So then let's come to different types of derivatives. The first one and the foremost and the easiest one is forward contract. Forward contract, let's try to understand through this scenario. Or let's do one thing. Let's take a break of 10-12 minutes and then again reconvene at 8:40. Okay. And then we will be continuing with our further discussions. we were having a discussion on types of derivatives. So let's start with the new type of with the first type of the derivative, forward contract. So forward contract, students, let's try to discuss with this case study. So let's say there is a procurement manager whose responsibility is to procure relevant quantity and at the cheapest prices available for specific things. Right now, this case is on the crude oil. Let's take an example of a crude oil. So the procurement manager is having a task in hand to purchase crude oil which is of grade A, for example 20 liters, and delivery is required after 6 months because the production process will need such crude oil after 6 months from today. So it's not today but after 6 months. So there are two things what this procurement manager can do. Procurement manager will say, okay, after 6 months I can go to the open market and purchase the quantities, right? At whatever price available, I can just purchase and keep it. But then, second thought is there something that we can do today? Because what's the benefit of this information being available as on today? So the benefit of this information being available as on today is, can I block the deal today itself for the quantity that I can receive after 6 months, and I can pay after 6 months as well. So whether this kind of a contract can be made, the answer is yes, it can be made. Now, let's say the today's price is rupees 100 for grade A crude oil. Okay, 200 rupees per liter. Now after 6 months the prices are likely to go up, right? Because there is a, let's say, information in the market that specifically crude oil will go up because of XYZ reasons, right? Now what does procurement manager thinks? Procurement manager connects with the supplier and agrees to take, no, option we will go later, Jyoti, option we will go later. As of now we are discussing about forward. So the procurement manager will lock the price at 110 per liter, assuming that today is 100, so maybe after 6 months it will be 110, but let's lock it at 110. The supplier agrees to it to supply 20 liters of grade A crude oil to procurement manager. So this is, they have done a deal lock today. Okay, they have agreed the terms and conditions of this deal. Now, what will happen after 6 months? There can only be three different situations. This is the actual price. Okay, let's focus on this column. So, if the actual price is 115, this we're talking about after 6 months. Huh? So, if it is 115, that means the negotiated price of 110 is a better deal from procurement manager's perspective. Right here we have put procurement manager and here we have put supplier. So because of this 110 rupees deal, still the sale purchase will happen at 110, but the market price was 115. So this procurement manager is able to save 5 rupees, and hence there is a gain of 5 rupees. Clear? There is a 5 rupees gain here. From supplier's perspective, there is a 5 rupee loss. Right? Because this supplier, had he not entered into this deal, they would have sold it in the open market and realized 115, which is a higher price. But now they are able to realize less. Okay, so there is a loss. Similarly, if the price has become 95, which is lower than the deal price, the 110, then there is a 15 rupees loss to the procurement manager, because the procurement manager would have purchased it in the open market at 95. Clear? So if you see, always in a derivative, the comparison is between the agreed terms and conditions with the market reality, right? So agreed terms and conditions versus what is the market going on. These comparisons gives out that who has benefited and who has lost. Now, similarly, here the supplier will feel that because of this agreement, I am able to realize 15 rupees higher, right? Had I not entered into this agreement, I would have only realized 95 rupees. Now, because of this agreement, which is a mandate for both supplier and procurement manager, I will end up getting a 15 rupees gain. Clear? And then if it is 110 minus, sorry, if this is 110 itself, the third case can be that. So there is no impact, students, in that case, right? Because your agreed price is also 110, the market price is also 110. So there is no gain, no loss. Clear, students, till now? Now let's also talk about how will the settlement happen of these forward contracts. Now settlements of these forward contracts will happen after 6 months once the period has been expired. After 6 months, the procurement manager will pay 2200, right, which is 20 liters into 110, the agreed rate, to the supplier, and supplier will deliver 20 liters of crude oil. So there is an actual outflow of the source funds, and there is an actual delivery of the product. This is called as gross settlement. Remember, we discussed there are two types of settlement: gross and net. Just before the break, we discussed, right? There are two different types of settlement: gross settlement and net settlement. So this is an example of gross settlement. So forward contracts are over the counter contract, students. These are highly customized. Okay, these are highly customized to the needs of both the parties, right? Let's say the supplier and procurement manager here. These are not standard contracts. Standard contracts are something like futures that we will discuss, okay, subsequently. But forward contracts are highly customized and they are over the counter. Over the counter means there is a counter, let's say there is a table, there are two parties sitting across the table, both of them agree and both of them decide that this is the over the counter contract and these are the terms and conditions and hence we want to pursue this. Okay. Then futures, students. Now, futures are the financial instruments which are standard contracts. Okay. Standard in terms of the quality of the underlying, the quantity of the underlying, and even the lot size. The lot size, it will say that it will be 100, 1000, 500, whatever it is, it will be specified in a standard contract. Now, because this is a standard contract, these are traded on a stock exchange. These are traded on a stock exchange. Whatever is the gain or loss using the stock exchange numbers can be computed. Okay, because these are futures. So futures are standard contracts and hence they can be traded on stock exchange. Now, because they are traded on a stock exchange, you cannot go and deliver 20 liters crude oil, right? For example, if it is on a crude oil future, so you cannot go and deliver such crude oil, right? So stock exchange, the trading today, nowadays, if you see, even the shares also which will get delivered or procured or sold will also happen through demat form, dematerialized form, right? So these are settled on net basis because these cannot be settled on gross basis. These futures cannot be settled on gross basis. Hence, these are settled always on net basis. There is no actual delivery. Whatever is the gain or loss, the person who has gained will receive, the person who has lost will pay the amount. Simple. So futures are also extended version of contracts, right? Sorry, extended version of forward contracts, which are as much simpler as forwards. But the only thing is, these are standard contracts. Forwards are non-standard contracts. These are traded on stock exchange. Forwards are over the counter. And futures are settled on net basis. Forwards are settled on gross basis. Okay, because they are entered with the specific objective of settling the gross. Okay, clear, students? Perfect. So then let's also move to our further discussion using this example. Now let's say there is a equity share of X Limited, students. Okay, there is a equity share of X Limited. Case 1, prices are going up in the time to come. Right, while we say that the prices are going to go up in the time to come, then what should be our strategy? We know that if the prices are going to go up, what we will do, we will buy the futures or sell the futures. So remember, students, the procurement manager had an intention. Okay, let me just clarify from here again. Yeah, this one. So if you see this table, whenever the price have gone up, okay, the procurement manager have gained. Whenever the price have gone down, the supplier have gained, right? This is the conclusion that I'm drawing. The procurement manager is in the shoes of the buying contract, right? Buying party in the contract. Supplier is in the shoes of the selling party in the contract, correct? Because procurement manager will buy the underlying and supplier will sell the underlying. So they are So the buyer will always benefit from a forward or a future contract if the prices are going to go up. Clear? And the seller will always have a benefit from the futures or forward contract in case the prices are going to go down. Clear, this relationship or this understanding is clear to all of you, students? Perfect. So now, in this case, the prices are going to go up in the time to come. Now, if the prices are going to go up, I will enter into a buying position. I will buy the futures. Buying the futures means that I am I am expecting that the prices of the underlying will go up, and hence I will lock my price at the futures value today in the buying position. Okay. Similarly, there is a selling position that is separate, right? So if 100 is the base price, 120 is the price at where it is going to be. So what I will do, I will sell at 120, buy at 100, and I will make a profit of 20, right? This is what I do. In case, okay, you just forget that we are talking about derivatives. Just think it from anything. Let's say you know the prices of gold are going to go up. What will you do? In case you want to earn, you will buy the gold today, and when the price goes up, you will sell the gold, and hence you will be able to earn the profit, right? So, similar thing for forwards and futures as well. Case 2, the price is expected to go down in the time to come. Now, this is an important one. Now, if you expect that the prices are going to go down in time to come, then what will you do? Come on, students, tell me. What should be the strategy that if the prices goes down, I can gain? In what position? Whether I should be in the buying position or I should be in the selling position? Come on, students, tell me. Okay, Lavanya have responded. Any other responses, students? Think, if the prices are going to go down, what should you do? Okay, students, there are two ways to make the money. Okay, what are they two? So let's say there is an expectation that the price is going to go up. So what I do today, I purchase, and after 1 year I sale, right? So 20 rupees I gain. Simple. 20 rupees I gain. So today I purchase, later on I sell. So 20 rupees I gain. This is just, yes, Jyoti, you are also right. Lavanya, you are also right. So this is the strategy that I will do in case I know that the prices are going to go up. Now, in case the prices are going to go down, let's say 120 is something that is today, and after 1 month the price has moved to 100. So what I will do, I will sell today and I will purchase later on. Can I do that? The answer is yes, you can do that. But while you sell today, how come you sell anything which you don't have? How come you can sell anything which you don't have? So please to remember, students, we are not talking about the underlying here. We are not talking about the underlying here. We are actually talking about the derivative contracts, right? And as I said, derivative contracts are separate from underlying, right? They don't, I mean, they are totally separate from the underlying. These are just financial contracts, right? So if you see, these are just financial contracts. So can I enter into a selling position today? The answer is yes. We can very much enter into a selling position today, and then later on we can have a purchasing position and earn still 20 rupees of profit. So what will I do here? I will, in case the price is expected to go down in the time to come, I will sell the futures. Okay. So same thing. Buying is called as long position, selling is called as short position. So students, please do remember, you will be hearing this terminology all across these topics, that Mr. X have taken a long position. That means Mr. X is in the buying position. Similarly, you will also see Mr. X has taken a short position. That means Mr. X is in a selling position, right? They want to sell, they want to buy. Now, if today is 120 rupees and tomorrow is 100, then this is the same thing that we discussed, right? That you will today sell and after 1 month you will buy. Okay. So the underlying in cash market or spot market is there, right? Because in these markets you are dealing on the you're dealing on the different equity shares on the futures and the options market. This is called as the FNO market, futures and options market. In this, futures we have already discussed, options we will be discussing, long or short selling we will come to it. Now, in underlying or in the cash market, students, where the actual share sale purchase happens, right? It is okay to take a long position, and in FNO market also it is okay to take a long position. There is no restriction to it, right? You can purchase a share today in the underlying market. You can take a long position in a future shares today. Okay, that is also even allowed. But short selling, first of all, is it allowed in FNO market? The answer is yes. Futures and options market, the short selling is definitely allowed. Okay. But is short selling allowed in intraday and intraday? The answer is in intraday. Intraday means within the same day you purchase and within the same day you sell. That is allowed, because if let's say today in the morning I sold something, okay, today in the morning I sold something, and by evening I have purchased the same thing. So then whatever delivery will happen for the today's sale and purchase, it will happen at one go, right? So I will still be able to purchase and sell simply. So that's where they allow it. But if it is interday, that means today I want to sell and tomorrow I want to purchase, that is not allowed. Because today if you sell and your settlement is going to happen for today, then you don't have anything to deliver, right, in terms of the underlying market. or in terms of the cash market. So here short selling intraday allowed, intraday not allowed. Here short selling is allowed for futures and options market. Clear? Okay. Then futures are totally delinked to their underlyings, right? Because as I said, that futures have buyer and seller different from underlyings buyer and seller, right? There is a cash segment which is in the underlying. Forwards are called as OTC. Forwards are called as OTC, which are highly customized. These are on actual basis, 100% settlement happens on gross basis. So these are the forward contract, students. The futures are actually standard contracts. These are traded on stock exchange and it gets settled on net payoff basis. Clear, students? Till now, I hope. So this is the entire discussion on cash segment, the forward futures, right? Now let me ask you a question before moving to pricing. Okay. Now, let's say you have, let me add a new sheet first. Okay. Let's say there is this underlying, and then there is a future. Okay. We will come to what is the pricing of the futures that we have not covered yet, right? We will come to that. But this is a very basic question. Let's say underlying there is a equity share of X Limited, and the future is a future on equity share of X Limited. Let's say you have purchased share in underlying market. Okay, that you have purchased the share in the underlying market. While you purchase the share, just forget everything. Can anyone tell me what is the risk of purchasing a share? Today, if I purchase a share, then what is the risk I have? Come on, students, think and then tell. Yes, very good. Lavanya, you're right. Anyone else? I would say
Prices go down.
yes, you're right. Prices might go down. So that's the risk. So Lavanya, you're also right. You have also responded fall in prices. Now, if there is a risk of fall in the prices, then what should I do? Here also I have two options. Can anyone suggest me if I have to curb myself from risk of fall in the prices, then what should I do? I have to devise a strategy in which a fall in the price will help me to gain, right? Strategy in which fall in price will lead to gains. So this will happen how? This will happen how, students? Should I take a short position in futures or should I take a long position in futures? Yes, very good. Lavanya, you're right. Any other answer, students? I'm just trying to make you think. So I have to cover myself for the fall in prices and such that if the prices fall, I will gain. So there are two options. One, I can sell the shares itself, right? But then what's the point? If I have purchased the share and if I am going to sell it to eliminate the risk of fall in prices, then what's the point of purchasing the share? So it's not at all logical. Then the second option left is actually to take a short position in futures and continue your both the transactions. The first transaction in underlying is a separate transaction, and the second transaction in futures is also a separate transaction. So if tomorrow the prices goes down, you are covered here, correct? You are covered here. Clear, student? So just think it from that perspective that what is the risk that you're trying to cover? Now, if that risk you're trying to cover, what should be your position in the futures market? That should drive your overall strategy. Okay, now let's come to pricing, students. Yes, this one. So the pricing of futures or forwards, the pricing is common for both of them. We can discuss both of them together. Okay. Now, for pricing, let's first try to understand the different parts of compounding. Okay. I am sure all of you might be knowing this. Good morning, Sachi. So I'm sure all of you might be knowing this, but let's try to revise it. So compounding, students, we know there is a future value, there is a present value, there is a rate of return, and there is a time period, right? There is a future value called A, there is a present value as P, there is a rate of return, and there is a time period. Okay. Now, this is a simple formula where your present value multiplied by 1 plus r raised to the power t will be used, right? Just a second. Yes, this is CA final, yes. Okay, Sachi, yes, this is for CA final itself, not for CA foundation. Okay. Now, if you see in this, what we are doing, we are just taking a factor, right, raised to the power t and multiplying to the present value to arrive at the future value. What if we have a semi-annual compounding? Sometimes the question might say that the compounding is happening twice in a year. So it will be A is equal to P 1 plus R by 2. So the overall rate will be reduced to half and raised to the power 2 into time period, right? Because twice the compounding has happened. So we can just remember this formula. This is for discrete compounding, right? That means A is equal to P 1 plus R divided by N raised to the power N T. Future value, present value, rate of return, time period, and N is the number of compounding in a year, right? How many times the compounding is happening in a year, that is called as N, right? Now, for example, our rate of return is 10%, time is 3 years, right? And we are talking about quarterly compounding. Every 3 months, the compounding will happen. So the formula will look like A is equal to P 1 plus 10% divided by N. N is how much here? 4. Correct? Because in a year, 4 times the compounding is happening. So divide by 4. Overall raised to the power 4 into 3 students. Okay. So this is what discrete compounding. Now, can anyone tell me what do we mean by discrete compounding? Discrete compounding means that the compounding is happening separately, right? It's not, you can separate one compounding from another compounding. That's where it's a discrete compounding. There is a another compounding called continuous compounding. This is opposite to discrete. Now, continuous compounding means you cannot separate first compounding from second compounding. So it is happening in a, let's say, at infinity level. So the n, it becomes infinity because every millisecond the compounding is happening. So here n was the number of compounding in a year, right? So in continuous compounding, this n becomes infinity. This one. Clear? So this n becomes infinity, and hence a is equal to p into e raised to the power r t, which is called as continuous compounding, students. Clear? So this becomes a is equal to p into e raised to the power r t. So here a is actually the future value, p is the present value, a and p multiplied by e. E is the exponential function, right? So e, why are we using e? Because the n is unlimited, is infinity, right? So using that formula of limit n to infinity, so e raised to the power rt will deliver the same value. Now, value of valuation of forward slash futures. So this is about the pricing, right? These were the basic principles on pricing. What is meant by continuous compounding? What is meant by discrete compounding? Now let's come to the valuation of forward slash futures. Now, this is a very important part because till now we have discussed everything around. Now this piece will complete your understanding of forward slash futures. If you see, students, the forwards or futures, we said that it is deriving its value from the underlying, right? Now, how do they derive its value from the underlying? There is a spot price today of that underlying that is called as the present value because on that value, the transactions are happening in the market. So that is called as spot price, current price, or present value. Then ultimately there is a future value, right? If we do the interest rate multiplications, the factor wise multiplication we discussed above to the present value, we will arrive at the future value. So that future value represents the value of that forward or future today. You're getting my point? So the price of forward slash future is equal to the future value of spot price. And what expiry we will take here? What is the time period that we will take here for calculating the future value? So remember we discussed that every derivative have a expiry, right? So these derivatives, whenever they have a expiry, let's say 1 month, 2 month, 3 month, let's say 3 months is the expiry date. No, so 3 months future value of today's spot price will be the future value, which will be the price of that forward slash future. Okay. So this is the time period for calculating the future value. Clear? So it's nothing in terms of the valuation of the forward or future. You just need to take the present value, just calculate the future value. Whatever is that future value becomes the price of that forward future today. Okay. Now, discrete compounding, students, we discussed this formula above. Sorry. Continuous compounding, students, we discussed this formula as well above, right? Now, if today spot price is 100 of X Limited, sorry. So the 1 month expiry, 2 month expiry, 3 month expiry would be getting traded at 101, 102, 103. This is the future value. So rupees 101 is the future value of rupees 100 after 1 month. Sorry. Now there is a specific discussion on dividend and transaction cost, right? Because the underlines, the way they operate, there is a transaction cost, there is a dividend as well. Now, how does that get adjusted? there are different cases that we need to discuss, right? One, if we talk about a discrete dividend. Now, sometimes the question will also tell you that is it a case of discrete dividend or a continuous dividend, students? Okay. And let me tell you, both of them are very much different. So, in reality, while dividend is paid out, it is always discrete dividend because you can differentiate between the first dividend, second dividend, third dividend, right? Okay. In reality, the dividend is always paid out discretely. But while analyzing any stock, any share price, a continuous dividend is also used because it tells you that what percentage of dividend is generally accrued to that stock. For example, 5%, 6%, 10%, that's their continuous dividend that is getting accrued to the stock and it gets paid out at regular intervals. Okay. So the first case is about the discrete dividend. So the discrete dividend will be, the formula remains as is. The only thing is from the present value, we just reduce the present value of dividend. Why are we saying the present value of dividend here? In case, let's say the dividend is payable after 1 month, after 2 months, after 3 months, the present value of that dividend needs to be taken. Clear? The reason why, the next question comes, why this present value of dividend is reduced? Because in a forward or a future transaction, the dividend is not paid. The dividend is always paid on the actual underlying, right? Always in the spot market, the dividend is paid, but in the futures or forwards market, there is no dividend that's get paid. So we need to remove it. Plus, the present value already have built up of this dividend that is expected to be paid, right? We called it as come dividend price or ex dividend price. So the price that is achieved here is called as ex dividend price. Clear? Perfect. Then let's also discuss what will be the transaction cost. So the P minus present value of dividend is as is. In that, the transaction cost gets added. Because transaction cost is a cost that gets added even to the futures and forwards valuation and even to the underlying valuation. So we will add it. And this remains same. Here the only change is in case the continuous compounding is there, then we will just do e raised to the power r t. Okay. Now if there is a continuous dividend, students, there can be a case where there is a continuous dividend. Continuous dividend will mean that continuously the dividend is accruing to the stock. So in this case, A is equal to P into E raised to the power R minus Y. So R is the rate at which it is increasing. Y is the rate at which it is decreasing into T. This is very, very important. So Y is the dividend yield that has come in. Okay. Then on expiry, the price of future is equal to the price of the spot. This is a main thing wherein on the future, the on expiry, since there is no expiry left, right? So there is no time to expire. The present value and future value will become same. Correct? Can be shown through this example. So this is the difference in future price versus spot price, right? The y-axis is telling you the difference between the future price and spot price. And here it is the time period. So the expiry, as we move closer to expiry, the present value becomes the future value, or I can say the future value becomes the present value, students. Clear till here, till now, everything is clear, students? Let me pause and check if there is any questions, any clarifications. So with this, we have covered the pricing part of the derivatives, specifically on forwards and futures. Okay, now let's see what are the applications of forwards and futures. Where are they used? So first of all, there is a term called speculation, students. Speculate. I speculate that the prices will go up. I speculate that the prices will go down. So there is a speculation means there is a one-sided expectation, right? So it's a hope of gain versus risk of loss. It whether I am hopeful that I will gain, but at the same time I am also having a risk that I might incur a loss. So speculation is this. Now let's take this example to discuss. So we are talking about a long position in futures of X Limited, and there is a short position of futures of X Limited, because while somebody is entering into a long position, the other party has also entered into a short position, correct? Then only we will say that the future selling and buying is complete at that level, right? And in this, let's say the price at which that they are entered is 80, the lot size is 1000, that means the contract size is 80,000, students. Clear? Then on this 80,000, 20% is the margin. So why there is a margin? Because while you deal on a stock exchange, while you enter into a long position or a short position on this 80,000, there is nothing that you have to pay, because it is just a commitment that I am entering into today. It's not a real payment or receipt. However, in the case of shares, there is a real cash outflow, there is a real cash inflow that happens, right? But in this case, since the real cash inflow outflow is not happening, they ask to keep a margin. Okay, they ask to put a margin, and that margin will be deposited with the stock exchange as a safety measure, that tomorrow if the long position person is losing, the money can be taken out from the margin and paid to the person who has gained, that is the short position person. Okay, so let's discuss how. Now on expiry, students, we have taken two cases. Let's say if the prices goes down, if the prices goes up. Now all of you tell me, students, from a person who has taken a long position, if the future prices goes down from 80 to 70, whether there will be a gain, there will be a loss at the long positions end. Come on, students, I want all of you to answer. Please do
Loss.
remember. Yes, loss. Very good. Lavanya, you're also right. The reason why there will be a loss is because the prices have gone down. I have entered into a long position. Okay, so in a way, earlier I had contracted to purchase the underlying at 80 rupees, but now the underlying itself in the open market is at 70 rupees. So because of this contract, I have to give 10 rupees extra. That is what my loss is. So hence 10,000 becomes a loss. So 70 minus 80, 10 rupees is a loss. And that will get adjusted from my 16,000, balance 6,000 I will receive. Now, in case the prices have gone up, I have agreed to purchase the underlying at 80. The real market price is 90. That means I would have had I not entered into this agreement, I would have purchased at 90 instead of 80. Now, because of this agreement, because of this long position, I can benefit at 10 rupees. So I will gain this 10,000 rupees, 10 on 1000, which is 10,000, and 16,000 I have already given. So I will get back 26,000 to myself. Okay. Now, let's discuss about from the short positions perspective, students. Now, I want all of you to answer. In case there is a short position entered at 80 and the price has moved to 90, then tell me, in case of a short position, will there be a loss? Will there be a gain? Yes, Lavanya, you're right. So there will be a, come on, rest all of you should also answer. Make use of query handle, make use of the chat box. Please keep on answering so that I know that all of you have understood it right, and accordingly I can take some inputs. So I'm repeating the question, students. There is a short position taken on the futures of X Limited at the rate of 80 rupees. Now the prices have moved up to 90 rupees. There will be a loss in this case, or there will be a gain in this case.
Loss.
Yes, Jyoti, you're also right. And Manish, I think you're also right. It's a loss. Why? Because you anticipated that the prices will go down. That's where you've taken a short position, but the prices have gone up. Or, in other words, you have contracted to sell the underlying asset at 80 rupees, right? But the market price has become 90 rupees. So you would have easily sold in market at 90 rupees. Now, because of this agreement, you are losing 10 rupees. So there is a loss. So, whichever way you want to pick and understand and think, you can very well reach to the same conclusion always. So, this is a loss. And if the prices have gone down, now it's a favorable movement for a short position. The price is moving down, right? So it will be a gain. Because had I not entered into the agreement, I would have sold at 70. Now, because of this agreement, I am able to sell at 80. That means I am able to get 10 rupees more. That's a gain to me. And hence, overall 16,000 plus 10,000, I will get back 26,000. In this case, I will only get back 6,000. Okay. So this is the speculation piece where just speculation has happened. Now let's also talk about hedging. The second uses of derivative is hedging. And these are the terms which will remain common while we talk about a forward or a future, while we also talk about an option, while we also talk about an interest rate options, while we also talk about the commodity derivatives or even the foreign exchange derivatives. Okay. Then next part comes to hedging. Hedging means that you are trying to protect yourself against a risk. Okay, the entity is already exposed to a risk. Hedging against that risk by using forward slash futures. So that hedging against that risk is done using the forwards or futures or even the other instruments. So in this exam, in this specific case, we will discuss about the forwards or futures. Now, in case of hedging, there has to be a risk already been existent. And you are trying to curb against that risk. You're trying to mitigate against that risk, right? So, what is the risk? Risk is the risk of holding equity shares in spot market. That is the risk that you are holding equity shares in the spot market. Now, what is the risk of this? Risk that the prices will go down. This we have already discussed just some time back, right? Risk that the prices will go down. So, what are you going to do? You are going to sell futures, right? You are not going to buy the futures, you are going to sell the futures, because if you're going to sell the futures, then you will get back the money, right? The In case the prices goes down, right? That's the only caveat. So you will have to accordingly decide. So this process of devising the strategy to sell the future, buy the future basis your position in the spot market is called as hedging strategy, students. Okay, and this entire process called as hedging. So if prices goes down, there is a risk, there is a loss, there is a gain. So limiting loss or gain is the to the fixed amount is also called as hedging. So where you limit your loss is called as hedging. Okay. Example. Let's say you have purchased 100 shares at the rate of 300 each. So there is a risk of prices going down. It's in the spot market, students. Please do remember, it's in the spot market and futures. There is a short position. Futures, there is a short position that has been taken at 350 per share in the futures market, students. Because there is a risk of prices going down, they have entered into a futures short position. So there are three different cases: closing price 1, 2, 3, wherein let's say the closing price comes out to be 300 rupees. So let's think about both the scenario, I mean, both the situations. One, we have purchased the share at 300. Now the closing price is also 300. Then what will happen? Initially, I have purchased shares, so I will pay 30,000 rupees, right? This margin of selling the futures will be 100 into 350 into 20%. Let's assume that the 20% is the margin value. So 7,000. In all these three cases, my initial cash outflow will be 37,000 each, right? Because in all the three cases, while building this portfolio, I have already sold and then I have already paid the margin. Now, the basic share I will sell it out. First case I will sell at 300, second case I will sell at 350, third case I will sell it at 400, right? Closing price is 400. So what will I get? 30,000, 35,000, and 40,000. This is just pure as is. Then I will also get my margin back, right? Let me add my margin. Then I will also adjust my gain or loss on futures. Now, if you see, I have entered into a short position at 350. The prices has moved down to 300. Come on, students. Can you tell me whether I gain or lose here? In case of future short position, the prices have moved down to 350. Tell me whether I have gained, I have lost, how much I have gained, how much I have lost. Yes, Lavanya, you're right. Request others also to please make use of the query handle and or the chat box to drop in your answers.
No gain, no loss.
We are talking about case 1, students. Why do we feel there is no gain, no loss? The 350 rupees is the entry price at which the futures have been short sold. 300 is the current price. The prices have gone down. In case of a short position, if the price has gone down, there is a gain on futures. There is a gain to the extent of 5,000. So, Lavanya, you are right. So, 350 minus 300 into 100, there is a gain of 5,000. In overall, we will get 30 plus 7 plus 5. So 42,000 is what we will get at an overall level. Second case, students. Second case is 350. The futures have been also entered at 350. In this case, there is no gain, no loss, right? Because the prices are remain same. Third case, the prices have moved up. 400 instead of 350, the agreed price at the futures, the actual price has become 400. So what do you think here, the loss or the gain? It will lead to loss. Very good, Lavanya. And that to 5,000, which is 50 into 100. So it will lead to losses because the you have entered into a short position. The prices have gone up. Okay. And hence you will incur a loss. Okay. So what will happen here? 40 you have got from the sale of shares, 7,000 you have got back your margin, and 5,000 is the loss that you have borne. So in totality, you are earning 42,000. But now, if you see in all the three cases, students, our overall cash inflow, whatever is the price, may be higher, same, or lower, it's at 42,000. How much we invested in the portfolio? 37,000. How much we got? 42,000, students. That means 5,000 there is a gain that will continue. And how have we arrived at this 5,000? That is also clearly visible here. So what have you done here, students? 300 you have purchased the underlying, and 350 is something that you have committed to sell the underlying. So every time you will get this 50 rupees gain itself, whether whatever is the price, you will be getting this 50 rupees as gain. Clear? So this 50 rupees gain into 100, 5,000 is the gain that you will be getting. Clear? Perfect. So there is a long position, there is a short position, and there is a derivative, right? Derivative, it's a contract to buy on expiry. It's called as long position. Contract to sell on expiry is called as short position, students. Okay. Future price. So the contract to buy or sell, it happens on a future price, right? So it is exposed to the risk of downside, and the short position is exposed to the risk of upside, because tomorrow if the prices goes up, there will be a loss. Clear, students? Any questions, any doubts? Please do let me know. Okay, let's move ahead then. Okay, so then, students, we have covered a lot of questions in the detailed sessions. Okay, and the questions everywhere made use of these concepts of hedging, speculation. So there is one specific topic that I would want to discuss. So if you see till now, in derivatives, we discussed about forwards, futures, and we covered in sufficient detail what is a forward, what is a future, what are their valuation techniques, what are their characteristics, which strategy to take in case of which situation, right? Now let's discuss an extended part of this topic wherein we will be discussing about some of the specific things on hedging. Okay. So hedging, students, we said that protection against the risk an entity is exposed to, right? So this is what is meant by hedging. Now, there are different ways you can do a hedge. For example, you can do a hedge of X Limited's equity share in the spot market through the X Limited's futures, right? A futures operating on X Limited can be used to hedge, sorry, X Limited equity share position. So, for example, if you have taken a long position in spot market, you can take a short position in futures market, right? This we have seen enough examples above as well. If you have taken a short position in spot or cash market, you can take a long position in futures market. That is also okay. Okay. Then B part. There is X Limited's equity and there is index futures. X Limited's equity is beta. So both of them are related to each other. So index is what? Index is the market index, right? The market plus or minus that is happening in the stocks at a market level. Now, a specific equity share is having a specific beta which is related to that index. Now, beta is 1.2. It means that if market index moves by 1, X Limited will move by 1.2. Clear? If beta is zero point 0.8, market index is 1, X Limited will move by zero point 0.8. If beta is zero point 0.8, it means that X Limited will also move by zero point 0.8. So, if we talk about same stock, so cash and derivatives market take equal and opposite position. Simple. If we have to do the hedging using the same stock, then take equal and opposite position. But if you want to do hedging through market index, students, if you want to do hedging through market index, then what you do? You take the existing beta minus required beta multiplied by value of portfolio divided by the overall value. So existing beta is how much? The beta that is appearing from the market perspective, right, of that stock minus the quotient will tell you that what is the required beta. Let's say the quotient will tell you that devise a strategy, hedging strategy through which your beta is reduced to, let's say, 1. Your current beta is 1.2, but you need to hedge in such a way that your beta reduced to 1. So what you will do? 1.2 minus 1. Okay. This is the beta multiplied by the value of portfolio. Whatever is the value of that portfolio, let's say, whatever is given in the question that you are trying to do the hedging divided by the, so this is the, sorry, not divided by, this is the overall value that you need to hedge. Okay. Now, if you see, there is a, in case of equity, if you are on long index futures, what you will do, right? That's the next question. See, there are two things, right? One, quantity and position, right? Which position you need to take. So the quantity is something that is defined here, correct? The position that we need to take will be defined how? If X Limited is having a long position and beta is positive, students, now there is a another element, beta can be negative also, right? There are two situations, beta is positive, beta is negative. So let's talk about beta is positive. Beta is positive means that the stock and index will move in the similar direction. If the stock increases, sorry, if the market increases, If the market increases, the stock will also increase. If the market decreases, the stock will decrease. That is what is called as beta positive. Beta negative will mean if market increases, stock decreases, and if market decreases, the stock increases. Okay, that is also called, that is the beta negative, right? Now, what we need to do is, if beta is positive, then we need to take opposite position. If X limited, you have taken a long position, index, you take a short position, students. If X limited, you took a short position, index, you take a long position, right? It's very much similar to the same stock. It's just that beta needs to be taken care of. But in case beta is negative, then take similar position. Please do remember, this is very, very important. Because already, if you have taken a long position, the negative beta will mean that the market will move already in an opposite direction. So if there is a risk of upside here, then the long position has to be taken even in the index futures. I hope you're able to understand, because already your index is moving in an opposite direction. Clear? And if it's a short position in X limited, it will be a short position in index futures as well. So if you see, the questions generally revolves around, let's say your existing portfolio is 2 crore. On that, beta is 2 times. You have to take a hedging on that using a forward or a future in such a way that you reduce your beta from 2 to 1.5. Okay, and this will really help you determine how to calculate the value that needs to be taken out. Okay, I hope this discussion is clear, students. Now let me see what comes next. Maybe we will just introduce the concept of, yeah, this we already discussed, long position and short position, students. Any queries? Let me see. Yes, Jyoti, you are right. If beta is positive, opposite direction. If beta is negative, take same position. Very good. Good to see. Then this we already discussed. These are all questions, students. Yes. Now, this is something that we can discuss now. Yes. So there are two things, students, always, right? In, and this is a universal concept. See, there are certain things which are very universal. For example, the interest rates are inversely proportional to bond prices. It's a universal thing. The logic can be applied even to the principal only securities. It can also be applied to the cost of the capital asset pricing model, right? The cost of equity is inversely proportional to the market prices. So it's similar, and this is one of the other universal concept. So there are two terminologies, overpriced and underpriced. We always say that, for example, there is a land. Okay, it's the best example to use. There is a land. We say that this land is overpriced. Overpriced means that you compare two things. One, the actual value of that land versus the market price of that land. How much that land would give in the market. Let's say the market price of the land is 1 crore, right? But actually, you are having a transaction, or let's say you know that 1.2 crore is something that you will be able to deal with that land. So, what will you do if it is an overpriced? You will sell the asset. Whenever you feel something is overpriced, you will sell the asset. What if, let's say, there is something that is underpriced, right? For example, there is another parcel of land which is a market value is 1 crore, but the actual value of that land is listed to be 80 lakhs. Then you will say it is underpriced. I will just quickly go and purchase the land at 80 lakhs. So that means 20 lakhs is the initial gain or loss that will directly come to me. So as a general, as a universal principle, anything overpriced, sell. Anything underpriced, purchase. Right? Now, apply this concept on the forward slash futures that we have just now discussed. If any future is overpriced, students, let's say as per the valuation formula, right, which is the present value, future value, discrete compounding, continuous compounding, the futures value comes out to be, let's say, 100 rupees. But in market price, it is getting traded at 120 rupees. Then do you call this as an overpriced future? The answer is yes. If the future is overpriced, what will you do? You will take a short position in futures. You will directly go and sell the future, students, right? Just like you will sell any other overpriced asset, you will sell this future as well. You will take a short position in futures. Step number one. The moment you take a short position in futures, you expose yourself to the risk of prices going up. Risk of price going up. This is called as the the risk element in taking the short position. Then to curb that risk, what will you do? You will take a long position in the spot market. By taking a long position in spot market, you will be able to mitigate the risk of prices going up, because now if the price goes up in the spot market, you are holding these shares which you are going to sell, and then you will be able to realize some of the loss that you have made on the short position in futures. For taking a long position in spot market, what will you do? You will borrow money for taking such a long position, because then you'll have to purchase the shares also, right? Then you'll have to purchase the shares as well. And for purchasing the shares, you'll have to borrow the money. So the entire strategy, students, we always say that there is nothing in hand in terms of the capital. There is nothing in hand in terms of the equity shareholding. So we started with zero, and then at the end also, after doing all the transactions, we will not hold anything. We will also repay the borrowing. We will take out our investments, and there will be no borrowings or investment at the end. So if you do this strategy, right, you will be able to earn. You will be definitely able to have a arbitrage equal to this 20 rupees, students. That's what the concept is. Arbitrage means that you make benefit of different pricing in different markets. Okay. If future is underpriced, student, this is relatively easier. If future is underpriced, what do? You take a long position in futures market. Simple. I just go and purchase the futures. If I take a long position in futures market, I have to take a short position in spot market. But I cannot take a short position in spot market, as I discussed earlier. So what do? You just go borrow one share and sell it in spot, right? For taking a short position. I understand the borrowing of shares is also not possible, but from a theoretical building point of view, we are saying that you can borrow, take a short position in spot market because you want to take a long position in futures market. Then what will happen? On expiry, you purchase the share and return the share back from whom you have borrowed. In this also, you will be able to earn an arbitrage. Okay, so that's the whole story about how you should strategize while you know what are the different pricing mechanisms that are available. Any questions, students? I am keen to take them up from derivatives till now, the topics that we have discussed till now, or on securitization as well. I will also ask you to go through some of the MCQs. Let me know if you're able to see the screen, students. Perfect. So the first question, I want all of you to answer this. The concept of tranching. So this is these are the MCQs related to securitization, students. Okay. The concept of tranching primarily aims to reduce the size of SPV, allocate risk across different classes of investors. Okay. Perfect. Sorry, I'm just reading it out again. The concept of tranching primarily aims to reduce the size of the SPV, allocate the risk across different classes of investors, increase the number of underlying receivables, avoid compliance with regulatory norms. I request all of you to please put your, answers in the chat box so that we can go through and see. Yes, I think a lot of you are responding. Jyoti, Lavanya, and Chitra, all of you are correct. So the correct answer here is B, to allocate the risk across different classes of investors that we already discussed, right? Then, question number two, students. In a securitization deal, the role of a servicer primarily includes providing credit guarantees to investors. This is something done by some other party, right? Today only we discussed purchasing residual interest from SPV, collecting and managing cash flows from receivables, rating the tranches issued by SPV. Come on, students. I would request all of you to please answer. Jyoti, you are right. The students on call who are not responding, I request all of you please answer. Chitra, you are also correct. And Lavanya, you are also correct. So the right answer here is C, collecting and managing cash flows from receivables. Which of the following best explains the primary purpose of creating an SPV in a securitization transaction? To increase taxation benefits for the originator, to achieve bankruptcy, remoteness from originator, to guarantee investor returns, to enable higher leverage for the originator. Come on, students. So this is about the primary purpose for creating an SPV. I would request. Okay, there are mixed responses that I'm getting. C, D, C. So the right answer here is the answer B. Basically, to achieve bankruptcy remoteness from originator. Okay. So in the options that are given, this is the most relevant one. Now let's come to question number 4. In a pass-through securitization structure, cash flows from the underlying assets are reinvested by SPV before distribution, paid to investors after deducting only trustee fee, distributed to investors immediately as received, allocated based on credit rating of investors. Come on, students. Question number 4. It's an easier one. It's a straightforward. Yes, you're right, Jyoti. Your answer is correct. Yes, Lavanya, you're also right. So the right answer is distributed to investors immediately as received. So with this, the today's session on revisionary aspects comes to an end. I would now request C. Ashish sir to please help with the concluding remarks. Thank you, sir. Thank you, students.
Thank you, Devas sir. Thanks a lot. Your session was very encouraging and it was also very interactive. As student
Thank you,
taken
sir.
very keen interest in the same. Students, when the discussion was started, so I have joined the class in the beginning. It's my true confession. I could not join the whole class because of the morning time.
Perfect.
Anyhow, so sir has very, you can say, very clearly described the difference between factoring and securitization. Am I clear, sir? Am I right, sir?
Yes, sir. Yes, sir. But
Because
yeah, yes, sir. Yes, sir. Yeah.
recourse and non-recourse. So it also highlights that your concept of financial management is clear because factoring is in the intermediate financial management paper. And
Yeah.
second thing, more important is that security. When we talk about securitization, so there is one aspect when we talk about the problems or we can say challenges. So somewhere securitization has not become so much popular in India, but recently somewhere around May 25, one it has start listing has been started. Okay, so it is called mortgage backed securities and form was pass through certificate and it was issued by the mortgage was originator was LIC Housing Finance. Okay, and the special purpose vehicle who has issued the certificate is RMBS company. So what they have done, somewhere they, I think they have issued around 1 lakh each certificate, and I think amount is somewhere 1 crore, 1,000 crore. So they have issued this much of amount certificate, and I think coupon rate somewhere around is 7.65%, something like this. And even these certificate have a credit rating of ICRA and CARE, triple A. So it is a kind of an investment, say very good investment. Now, so we can say that now market is in the nascent stage, of course, but it has started. Thus, so I think this challenge will in a coming forthcoming time, this challenge will be over of the marketing because liquidity is one of the concern for the securitized security. So we hope with this, so I hope the topic of securitization must be clear to you. Now, sir has also started the derivative. So, student, please note that here in every class we give a disclaimer that the discussion is purely for academic purpose. And okay, we and here the purpose is, of course, we also discuss a speculation part also, but our purpose is to you make you aware about this concept is to use the derivative for hedging because derivative basically was originated for the hedging purpose. Of course, later speculation part has come into it. But my advice and even my request to you, please don't indulge yourself in derivative trading because it appears very fascinating. Oh, I can earn the money, but please remember, most of it has there is a report that many young investors has lost their money. So it SEBI has published a paper even that. So my request to you, please do it only for your concentrate on your study part and for academic purpose only. So that because your purpose is to clear the exam. Of course, once you become a chartered accountant, then you can do whatever you want. So student, this is our contact number. If you have any query, you can contact me over this telephone number, or you can send us a mail at this email ID. And Divas sir, we thank you very much. We thanks a lot for our
Thank
thanks
you, sir.
from our side because you have
Thank you.
saved taken out your precious time and enlightening the student on this topic. Thank you very much.
Thank you, sir.
So student, I
Thank you.
think Divas sir, we shall continue this topic of derivative in the next class.
Yes, sir. Yes, sir.
Okay,
And
student,
then
we shall
interested.
then other topic will be interest rate risk
Yes.
management.
Yes, sir.
Okay, student. So in the next class, we will take up these two topics. Thank you very much and for
Thank
the
you.
patient listening. Thank you. Thank you, Divasar,
Thank
once
you.
again.
Thank you, sir. Thank you, sir.
Thank you.
Thank you. Thank you.
Okay. Session over. Thank you. Thank you. Thank you. Thank you. Have a nice day. Have a nice day.